What's up guys, in this video, I will talk about the things you need to know before you start using the dividend investing strategy. But before that, just a quick intro to passive income and dividend investing. Now ever since I started investing, I always had a goal of comfortably retiring early. Yes, by the meaning of comfortably, it's not just to survive, but also to continue the growth of my money in the process without the need of working a 9-to-5 job. So that is where I started to study about passive income and how I ended up using dividend investing as my strategy. Now a lot of people underestimate the power of dividends since some stocks only give out a 1 to 5% yield per year. But what they fail to realize is, if you take dividend earnings out, your long-term gain would be cut down big time. We aren't just talking about a 10 or 20% cut. No, it is much larger than you think. Actually, if you invested $1,000 in the S&P 500 and just left it there, let's say for 100 years, and compound every single dividend and capital gain, that $1,000 would be a massive $131,000. But if you didn't reinvest your dividends and spend it, since you're one of those who thinks those small returns don't matter, your $1,000 would only amount to $39,000. That is a difference of more than 3 times. Although our time horizon is quite big, because we don't know if we could even reach 100 years old, but you get the point. In the long run, dividends play a very big role in growing your money. This is because dividends compound over the years. This is what we call the snowball effect. The more it rolls down the hill, the larger it becomes. For dividends, as you earn it yearly, the dividends you got if reinvested will earn more money for you the next year. And the best thing about it is you don't need to be actively trading stocks to do it, since you don't need to sell your stocks to gain money. So now that I've convinced you how powerful dividends are, the next step we need to take is how to approach dividend investing properly. First of all, we've already talked about the importance of reinvesting every single dividend you get, no matter how small it is. Put it back into your portfolio so that it can gain more money for you the next year. I like to imagine it like tiny workers working for me, non-stop 24/7. And those tiny workers multiply every year, creating more workers to work for me. How fun is that, right? And it doesn't complain. You don't even need to train them. So create your army of tiny workers as early as possible. Second, don't just focus on hoarding a lot of workers. You also have to take note of the quality of it. By this, you still have to do your research well in knowing if that company has good financials. This is important since we rely on the earnings of the company to get dividends. With the company having good financials and manageable debt, we can assure ourselves that our dividend source would be stable for a long time. And not only that, with the company doing good financially, we can also get a raise from it. This is if the company grows every year. With earnings growing, the more chance the company would pay more dividends to us. So look for a company that has a history of good growth and has manageable debt. Remember, a large debt can be a hindrance to future growth, and we also don't want a company that pays a lot of dividends to its investors through acquiring more debt. This wouldn't be sustainable. And you can also add in what the legendary investor Warren Buffett looks for, which is a moat. Now a moat is the one that surrounds the castle walls, defending it from those that try to shake its fortress. With a moat, this gives it a competitive advantage over its opponents. So from a company's standpoint, its competitors in the same field of business. Now there are different kinds of moats. One such is the company's products are strong and ahead of its competitors. Their brand has a good reputation and is well known to many. They have sustained earnings growth and manageable debt, so that when there's a crisis, you know they can easily get back up. With this standard, we can assure ourselves that we not only have a good quantity of tiny workers, but also have quality in it. This way, our dividend income would be more stable over the years. Third, you also have to take note of the price you're paying for that company. No matter how good that company is, if you're paying too much for it, then it may not be a good investment. Yes, not every great company is a good investment. You still have to pay the right price for it. Now, there are a lot of ways for you to know if the stock is undervalued or not, like certain metrics such as the PE ratio, price to book value, or you can compute the intrinsic value of the company to come up with a good buy price for it. Now, I have a video of how I compute the intrinsic value and buy price. I'll leave a link below. Now, if you don't like to compute it for yourself, there are some websites out there that already do it for you, and you can combine it with other metrics to assure yourself that the company is really trading at a discounted price. Although this is not an exact science and still doesn't assure you good returns, it's still a good way to have some guidance on what companies to buy. But always remember, never use a single metric to evaluate the company. This has to work hand in hand with other price metrics, and the company should have good financials as well. Like Charlie Munger and Warren Buffett's principles are, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And if you really don't like to do this, there's still a way to skip everything and just buy a fund or an ETF that gives out dividends and cost average every single month in it. Saves you all the trouble of analyzing individual stocks. Anyway, let's continue. The fourth thing you have to take note of is that there is no free lunch. Some investors chase after dividends alone. They buy the company during or just before the ex-dividend date, then sell it afterward. Well, you may be lucky sometimes by using this strategy, but what often happens is this strategy won't work and you would end up losing money in the process. The first reason, if you actively buy and sell stocks, you incur unnecessary fees and taxes. Second reason, most stocks after announcing dividends, yes, do sometimes rise in stock price, but quickly drops afterward. With this, you're not even sure if you would break even or lose more money even with the dividends you get in the process. So if you're aiming for dividends, just do the simplest way. Hold good companies you bought at a discount and hold for a long time. Fifth, diversify properly. Now, if you're just buying an ETF that gives out dividends, then there's no problem for you since you're already diversified properly. Most investors just diversify for the sake of holding a lot of companies at hand, disregarding everything that I said a while ago. The term to describe this is diversification. So there's a proper way to do it. One is what we talked about a while ago. Your portfolio should consist of companies that have good financials that you've bought at a fair price. Second, you diversify across industries, such as owning companies in the real estate, tech, or power industry, for example. But always remember, it has to be in your circle of competence. If you don't have any clue how the power or tech industry does its businesses, then don't own one just for the sake of diversifying in that field. Study and understand it first before you buy. Next, you can diversify across time. This is by cost averaging, or the right term for us since we are buying companies at a discount, value cost averaging. This means if that company goes below your buy price, then you buy at different time frames over a long period. Now, I have a video explaining this in detail. What is the difference between the normal cost averaging and value cost averaging? And lastly, for today, be patient. This is probably so simple, yet this is actually the hardest. Now, investing takes time. It isn't a one-day millionaire scheme. Compounding takes time to work. That's why you got to have a long-term mindset. Warren Buffett says that if you aren't willing to own a stock for 10 years, then don't even think about owning it for 10 minutes. That's why with all that I've said a while ago, you should own great businesses that you know you will be comfortable holding for more than 10 years. This way, you don't need to worry about the daily fluctuations of the market, which in turn helps your mental well-being and would be of help to you to go for the long run. Don't underestimate these basic fundamentals and just focus on the complicated strategies and formulas. Even if you know all of those things, it would be useless if you can't even let compounding do its work, or if you panic every time the stock market takes a downturn. For me, this is probably the most important one to learn. With that, this ends this video for today. Now, there are a lot of choices for you in using dividend investing as your strategy. One such is a simple way, which is to buy an index fund or an ETF that gives out dividends and invest in it consistently for a long time. And the other, if you like the thrill of buying individual stocks, then these points I've said would definitely be of help to you. Start early as much as possible so that one day the dividends you get every year would be bigger than your main income source. So I hope you've learned something, and if you did and still haven't clicked the like button, then I'd appreciate it if you do so before leaving. Now, if you want to learn more about dividend investing, I also have a book summary of The Little Book of Big Dividends. I suggest you watch it as well. So thank you and see you in the next video.